Okay, this is the last part of chapter 7. The analysis of the stock price evaluation we had in the previous section depends on the people's expectation, right? Especially expectation of the cash flow. So we are trying to find the theory behind how people form expectation. In the 1950s and 1960s, economists regularly view expectation as a form from only the past experience. So the view of expectation from using only the data in the past is called adaptive expectation. However, later on, economists think that people use more than that. They use more information than the past data. They also include the prediction of the future monetary policy as well as the current and past monetary policy, right? So people often change their expectation quickly in the light of the new information. To address this objection to the validity of adaptive expectation, an economist, I'm not sure if he's an economist or mathematician, John Muth, developed an alternative theory of expectation called rational expectation, which can be stated as follows. Expectations will be identical to optimal forecasts, the best guess of the future, using all available information. So basically, he said people use all information. It's the past data, it's the current issue, and it's the form of prediction in the future. So this is the core for the theory of rational expectation. So we are using this theory to describe the formation of the business and consumer expectation. Also, the stock price evaluation. This is an example of adaptive expectation. It suggests that change in expectation will occur slowly over time when the past data change, right? So as of today, you have the data from yesterday and you form the expectation of today from only the past data. If the inflation rose to a steady rate of 10%, expectations of the future inflation would rise towards 10%, but slowly. That's the implication. So the argument is people do not use only the past data. They also use more information to form their expectation. And that is the core thing that behind rational expectation. So expectation of the inflation are affected by people's predictions of the future monetary policy as well as the current and past monetary policy. And the expectation change very quick. Joe travel. This is another example. Joe travels when it is not rush hour. It takes an average of 30 minutes for his trip. Normally he commute to work and take 30 minutes. However, during the rush hour, it will take him additional 10 minutes to get to work, right? So the optimal forecast for when he leaves work during the rush hour, he could expect, average is 30 minutes from the past data, right? But additional information is it will take another 10 minutes when it is rush hour. So together, it is the optimal forecast of 40 minutes. That's how you use all available information to form the expectation. Okay. So what is the implication of this theory? So if there is a change in the way a variable moves, the way in which expectation of this variable are formed will change as well. The forecast error of expectation will, on average, be zero and cannot be predicted ahead of time. So if it can be predicted, that means you have the information about it, and you should include that piece of information to your expectation already. So on the forecast error based on the theory of rational expectation over time, on average, it should be zero. So it could be fluctuation, the error up and down, right? But together, negative and positive should cancel all out and then it becomes zero. If Joe realized that on average he is 5 minutes late for work lately, so he know that fact, he should improve that forecast by increasing it by 5 minutes. So the error will converge to zero by the theory of rational expectation. When you adapt that theory of rational expectation to the financial market, it becomes theory of efficient market or efficient hypothesis. So it is financial economists that were developing a parallel theory of expectation formation in the financial market. So they said expectations in financial markets are equal to the optimal forecast using all available information, right? So this market hypothesis, efficient market hypothesis, is based on the assumption that price of securities or the stock in the market, it fully reflects all available information already. So the rate of return on the security come from the expected price that you think you can sell this stock or this security in the future time t plus 1 minus the price that you bought, price of this security, right? Plus the cash payment over the price that you bought. And whenever market has new information, it will adjust immediately and it will continue to change the fundamental value of this. So what happened is if the cash payment come from the dividend, right? And the Gordon growth model, we said the dividend has the growth rate in the future. When the new information come in, the news, let's say it's good news, G will be increasing, right? The growth rate of the dividend will be increasing. How about the price, the expectation in the future? This company just announced the expected profit for the next 2 quarters. So the price in the next period could change, the expected price could change, and then everything together, it should reflect the return. Normally, the stock price movements are unpredictable. If you could accurately forecast that the price was going to go up tomorrow, you would immediately buy it today, right? So demand increase and the price increase today. So your accurately forecast will be already included in the price today. So the movement should be unpredictable, because if you can predict, it should be already inside the price. Any prediction that cause people to buy or sell the stock change the price through simple supply and demand already. The movement here that are unpredictable, they call error, right? We don't really know the error, or it is the part that we cannot explain it. What does it mean? What is the implication for the portfolio in terms of portfolio management? It means that active portfolio management will not yield a higher return than the broad stock market index years after year. So if you take some time, the management of a specific portfolio should not get higher return than the market average, because whatever that portfolio manager know, other people will know that as well. If you know some piece of information that is very inside the company, specific company, that is called illegal, right? That's insider information. So what is the evidence suggest? It suggests both that prices are unpredictable, and over time the error converge to zero, go up and down all the time. Professional money manager cannot beat an index like S&P 500 regularly. Their returns are around 2% less than average stock market return. They have to take a lot of sample, right? They're not talking about a specific person. But we do see some manager who claim to exceed the market. Some people claim that. How? How do they beat the market? First of all, they have inside information, which is illegal. Second of all, they are taking on risks and are compensated as such. They probably choose some type of stock that consider very high risk, and they are lucky and get that return. Or the fourth one, it's probably market that is not that efficient. They say that it's perfect information, which means everyone should know if one person know in that market, but probably it is not the case in reality. So if you invest the stock in the long run, it appears to be risky, but people hold a substantial proportion of their portfolio in stock. Either stocks are not that risky or people are not that risk averse. What is the case? This graph show S&P 1 year and 25-year stock return. It is time series 1872 to 2013, and you can see that if you take just 1 year return, it go up and down all the time, right? But if you take average 25-year return, it's pretty much kind of stay the same. So it's kind of evidence that you can really beat the market. And also maybe holding the stock for a long time is not that risky. But a lot of people, most of the time, holding stock for a very short time and hope for the return on the gap of the price, right? They don't really think about the dividend or the fundamental value of the stock. There is one study, Professor Jeremy Siegel, he suggests that investing in stock is risky only if you hold them for a short term. So from the previous graph, figure 8.2, average real return was 8% per year. In the past 50 years, minimum was negative 35% in 2008, and maximum was in 1996. So it go up and down over time, right? But on average, it's about 8% per year. So if you hold a stock long enough, they are not that risky, right? So that's the main point. If you hold a stock for 25 years instead of 1 year, that could give you some return that is not up and down, right? And if you take a look, stock are less risky than bond if you hold it for a long time. There's still some argument about beating the market. So the last part of your textbook is talking about behavioral finance. There are a lot of doubts about the efficiency of financial market, right? Triggers by stock market crash of 1987 led economists such as Nobel Prize winner Robert Shiller to develop a new field of study called behavioral finance. It applies concepts from other social science such as anthropology, sociology, and particular psychology to explain the behavior of the securities price. The efficient market hypothesis assumes that unexploited profit opportunity are eliminated by smart money market participants, right? But can smart money dominate ordinary investor so that financial markets are efficient? Specifically, the efficient market hypothesis suggests that smart money participants will sell when a stock price go up irrationally, with the result that the stock price fall back down to a level that is justified by the fundamentals. For this to occur, smart money investors must be able to engage in short sales. That is, they must borrow stock from brokers and then sell it in the market, with the aim of earning a profit by buying the stock back again or covering the short after it has fallen in price. Work by psychologists, however, suggests that people are subject to loss aversion. They are more unhappy when they suffer losses than they are happy when they achieve gains. Short sales can result in losses far in excess of the investor initial investment if the stock price climbs sharply higher than the price at which the short sale is made, right? So what does it say? Loss aversion can thus explain an important phenomenon. Very little short sale actually take place. Short selling may also be constrained by rule restricting it because it seems unsavory for someone to make money from another person's misfortune. This existence of so little short selling can explain why stock prices are sometimes overvalued. So basically, Robert Shiller tried to come up with more explanation why sometimes market doesn't seem like it is efficient. If you are interested to more detail of this, last part of your textbook has the detail. Okay, so that is chapter 7. See you next chapter. Bye bye.